morning, everybody. Hey, Albert.
Morning.
Yeah. So, hey, it's good to have another webinar for our monthly thing. So, Albert, I'll let you take it away here on looking into DSCRs
Okay.
here, and then we'll get into hopefully some depth and some good questions here.
Yeah. Good morning, everyone. Welcome to HomeX. We appreciate taking your time to come meet with us and have this presentation on jumping into the DSCR pool. Today, we're going to be discussing some important items as far as like what we can offer for you and what we can do for you with the DSCR program. Obviously, as a disclaimer, the content of this presentation belongs to HomeX. So, but again, we're glad to have you here with us. And this meeting is being recorded as well. And a copy of this presentation will be made available to you for your own records. Some of the things that we'll be discussing with you, as we had mentioned, is going to be with regards to this loan, how it applies, how you can use it to increase your business. We're talking about a little bit about the programs and then some recent examples that we have available of loans that we have done here at HomeX so that we'll be able to utilize it with clients that come across your desk. As far as some of the presenters, you'll obviously with me, Albert Martinez. I'm the corporate trainer here at HomeX. With us is also David Greider, who is our Senior Vice President of Wholesale Lending. And as a special presenter, we have Peter Hurley, who's one of our regional sales managers. So with that, I'd like to hand it off to David. Go ahead, sir.
Oh, thanks, Albert. And I appreciate you. And Albert just joined us in the last couple of months, and he's got lots of experience in corporate trading. And yeah, it just brings a wealth of knowledge to our team. So Andrea's still here. Those have been on other things, and she's going to take some other role in with our company. So we look forward to her furthering her career at Home Express. Kind of to start it out here, I just want to thank everybody on the call today, especially us in the mortgage business in this field. It's been a interesting couple of years, if I could put it that way, right? From the first quarter of 2020 and the COVID, and then the rates going down in the first quarter of 2022 with the rates skyrocketing up, and then what happened to the applications and housing affordability. And we're all looking forward to where can I get the next loan, or how can I keep this business going and into the future, waiting for the next time when rates will come back down a little bit, which they may soon. Who knows? NBA's been off a lot. If you ever saw my things on looking at what NBA forecasts, and this year is going to be interesting as well. But I did see some uptick. And there's a lot more business being done in non-QM as a percentage of the overall mortgage business, and more specifically for that small to medium investor. So I thought we'd talk a little bit about this for you today. And Home Express is a true lender. We underwrite our own guidelines, fund with our own money. We have highly trained account executives, so I don't go into a lot of details about the guidelines themselves. We just want you to connect with our highly trained account executive. They'll be able to walk you through it, and we have some really good streamlined guidelines for you to get that deal done and quickly for you. So let's just go over a couple of the business purpose non-owner occupied. The most popular is the DSCR, and I think it's because it's fairly easy to get through, meaning as long as you have the credit and the cash flow of the property, you understand that aspect of it, that's how it qualifies, right? Kind of more of a commercial type of product when you look at that. But also, I've seen a big uptick in income now, and that's based off credit and DTI, and it's still done for business purpose. It's fine, and you get a little bit better rate, and you don't have to worry about that DSCR percentage. So it's just based off income. So I've seen a lot of people utilize bank statements or self-employed, or even traditional 1 year or 2 year full doc. Properties that we can do, we're in the residential sector, so SFR condos up to 4 units. I put on their short-term rentals. That's kind of big, and there's a lot of news on there. We'll talk about that and even give you some examples. Condo hotels, non-warrantable condos, citizenship type. We cover all of it, and I can get a little more with your account executive what all that means, because a foreign national, what is that? How's that different from a non-permanent resident alien? We can go through that, but really is the identification part of that. Vesting, I was looking at this today. I was looking at our docu going in there today. And 10 of the DSCRs, we probably start out with 20 or so going to docu to send out, were vested in a business entity. And so we do allow that. We have a streamline. We review that pretty quick. It's usually same day or within 24 hours. We get it So the documents, the loan docs will be underneath the business entity, and there's a lot of small medium investors that prefer that. It helps protect personal liability by putting a lot liability on that property into that business entity. So we'll go to the next slide and go into a little more in depth of this program. All right, here we go. And again, DSCR stands for debt service coverage ratio. I think most people who have been in here on a purchase, we just use a 1007 or 1025. There's some carve outs if it's like if it was a short-term rental, we could actually look at what that performance had been for the last 12 months. But typically, we just use a 1007 or 1025. On a refinance, you can use either the 1007.25 or actual rents, right? And keep in mind on a refinance, cash out must be used for business purpose, right? And that's percentage. So it's 50% plus $1 it must be used for business purpose. If it's less than that, on business purpose, more on consumer purpose, it then have to be a TRID loan. And we can still do those. So I'll talk a little bit about that. We're going to talk about property types. On the calculation, it's done a little different from DTI on DSCR. DSCR, it's a full one-to-one. So there's no expense or vacancy factor off of that rental income that you take into that ratio. And really, even though it says one-to-one, that's where you want to be above that. That's what makes sense because, the renter, it covers that mortgage payment for you right there. The more positive is, the more income streams you have on it. But we do programs all the way down to literally zero DSCR. Again, that LTV will be capped and there'll be a rate ad for that. When you get to short-term rentals, they're a little bit different. We do, even on our DSCR, have a 20% expense vacancy factor applied. So, and I'll give you a kind of example of that. That's why I say some people use income docs to kind of get that unknown. So if you go through doing it, if you've kind of done a few of these, it's really, okay, I got great credit. Most of these do. They have the money down. The unknown is, what is that market rent's going to come in at? Right. And the other tool we have for those that are signed up with us, even if you're not signed up with it, you can have access through the portal. We have a retometer, which when you put in your property address and the number of bedrooms and bath count, you'll get back an email with average, with some comps in that neighborhood that could be used, right? So we're trying to get the guestscapes to be prepared of what that DSCR percentage would be. We'll go to the next slide, Albert. All right, so some calculations examples. And again, I know it kind of might be small print on your screen here. You're going to get a copy of this deck, everybody that registers for it, but just let you know, okay, how it's done, right? So the rent payment on the example here is 2,000, your PITIA is 1,900, DSCR is above 1, great, better rate, and you can get maximum LTV on that. Now, you look at the rent payments, 2,000, your PITI is 2,200, your DSCR is 0.9. Now, this just have a slight reduction in LTV, maybe a rate ad for that, because it's a little bit riskier if the rents don't cover the mortgage payment for the bondholder. So they have a little ad for that, but you still get done, and we go all the way down to zero, even though it's not existent. Going into reasons for that. And then we have short-term rental, the STRs. Purchase rate, we use 80% of the gross rents, right? There's a management fee, booking fee, cleaning fee, all these different things that we have to consider on those. But keep in mind when you do STR, and we're going to give you an example of that. One, Pete Hurley will come on and talk about one that closed recently, that they need to be in a higher density area of short-term rentals. And I always caution that. And you can, a lot of jurisdictions, you can have a short-term rental in places, but there's not really a resort type area, and your percentage of short-term rentals and your data won't come back as well with that. And you'll find out that using long-term rents probably is the way to go. Okay. Because you'll probably end up at the same spot. And I've seen a lot of individuals throughout the last 4 or 5 years look at areas doing short-term rentals and then switch to long-term rents. And so it's kind of good to know what that would be anyway. But with short-term rentals, especially on the resort areas, whether it's Lake Tahoe or some beach area in Florida, they go up and down. That's why we use a 12-month average. What I mean by the rent. So during the summer months on a beach area, that short-term rentals increase, go down in the winter months. And if you're in resorts area like Park City, Utah, The rents in the wintertime are higher because it's ski season and will slow down. That's why you need a 12-month average, right? So we can use what's on the 1007 that comes back, or we can use the air DNA if it's a purchase in those things, which I have example, or we can do a printout if it's a refinance from the last 12 months to calculate what that is. And so we'll show you an example on that. Next slide, Albert. Some of the highlights, I might go through a lot, but keep in mind the business purpose is non-TRID, right? So it's not as regulated as a consumer purpose loan, right? Now with some of our programs that you know, like especially we go to agency, they limit number of properties financed and all that. This has none, right? So you can the borrower can own as many properties they own. We can actually do 10 loans to the same borrower at one time, up to a 4 million aggregate, right? Non-TRID. We do send out LE and some CDs, even though it's not required, because we found out it's better to have the terms up front and they close. Hey, what's my loan look like? So we do send that out for you, for that borrower and you, so you kind of know where the loan's at, and the borrower's not surprised at closing. Right. And so with that, you can order the appraisal at any time. We do allow dual comp. What does it mean by that? If you're signed up with us for lender paid comp, let's say it's at 2, you can actually charge 2 borrower paid and to get 2 lender paid if you do it. Don't see a lot of that because the rate, you know, if the lender paid, you gets added to that. But there is a few times that makes sense to do. Again, talked about the cash out used for business purpose. We do DSCR down to 0.75 to 75 LTV and reduced LTV below 0.75 to 70 LTV. Minimum FICO to get in is 620. Again, we talked about the vesting in the business entity. And the good thing is there's lots of states where you don't have to be licensed through NMLS to do these business purpose. So if you're a loan officer in California and you have clients that want looking for rental properties in Texas or Florida, you're able to help them with that and close that loan through us. So the next page, I'm going to give you a map. This will come out to it. So everything that's in black here in the black states is not required to have an NMLS license for business purpose. So you can take advantage of that, and especially some of those looking at areas that where you know, it makes more sense to have more rental properties than maybe a SFR in San Mateo County, California, where the SFR prices are 2-3 million. You look at the rents, it's not going to pan out. But you go to certain areas where home prices and the rents are more comparable to get a DSCR and a cash flow of that property. And again, talk to your highly trained account executive. They're going to be able to help you out, give you this map. And by the way, you get this on the deck as well. So let's talk a little bit about, and I want to talk about a little bit about the non-owner occupied consumer purpose, which we're going to talk a little bit on the next slide here of why we have this program. Because you know, you know, even though we see consumer debt, that's credit cards, auto loans kind of going up, the good news is throughout the last, you know, 5-6 years, there's been a lot of equity gained by some of these property owners. And I've actually seen this in the non-owner occupied space for their investment properties. But sometimes they may want to utilize that equity and do a cash out refinance for personal purposes, right? That pay off debt, college tuition for their kids, whatever have you. So we do have that, but that would be a TRID loan, right? And it kind of follows the same rules. It's just on their investment property. So we can do full doc, 1 year full doc, W-2s only with lease agreements. Again, bank statements is, for the self-employed is great. And since it is an income file, we do have the expense factor kind of done traditionally. We use a 20% vacancy expense factor. Agency might use a 25. So it does help out a little bit. And we do a thing called net rents. If they have like 3 or 4 investment properties, we combine it all together on that is to get a positive income or whatever it is on a liability. But we find out is most of it's a positive on income. So it kind of washes out in their favor on the rental properties. So we'll go to the next slide, talk a little bit about some of the other things we have. Condotels, another thing that came up over probably the last couple years. There's some people doing it, but it's got more prevalent now. So what is a condotel? Condotel is they can be owner occupied second homes, but I see a lot of people using them as the short-term rentals in resort places, and we'll have an example of that for you as well. And the difference is like it's not necessarily a hotel. We have some qualifications on that because those are more of a commercial space, but they're more of the condos that have a booking service on site, or maybe not on site, but you can rent it out weekly or 2 or 3 days at a time, and they have amenities with that. And so we're able to get those loans done for you as well. And you can do them full or alt doc, DSCR. And I say by definition, they're short-term rentals because it says condotels, right? So it's not like you have two ads or go thing for short-term rentals. So you do condotel, that is fine, right? Even so, you see loan amounts from up to 1.5 million. We're able to look at those on an exception basis for certain areas. They go a little bit more for the right borrower. So a purchase, we can do 75% LTV, cash out to 65. That includes foreign nationals. So the things I take about is what is the qualification from a hotel to a condotel? We require, full kitchen, functioning kitchen. It's got to have 500 square feet, right? And a bedroom. So it's not the studio type, right? And that kind of differentiates just from the hotel to a condotel because it's residential. So utility of it could be for a second home, or owner occupied, or a short-term investment rental as well. So that's things on do that. So we'll talk some other expanded programs we've had in the past year or two. I-10s, we get a lot of questions on this, right? On I-10s. There's a lot of things out there. Try to look at that. And basically, what is an I-10, right? That's an individual tax identification number, and it's for a lot of individuals that are foreign nationals that came to the country. Could have been 20 years ago. And during the bomb era, what are we going to do with these people? They're part of the community. They work here. Their kids go to school. All these different things, but what came out says they just filed taxes underneath an individual tax identification number because they don't have a social security number, right? So we do those. There's a couple things we need, on that. They got to have a state or government issued ID and a copy of their I-10 assignment. And we do those for self-employed bank statements, right? So the credit needs to be underneath the I-10, at least 2 scores, and it starts with a 9. And then we can get the copy of this assignment and just do it like a regular loan, right? So keep in mind that you can talk to us about some of those other programs that's outside of the traditional, DSCR for that you normally do, or the self-employed bank statements or full alt doc. We'll go to the next slide. All right, this is where I'm bringing in Mr. Hurley, who's a regional manager for us in Northern California. Kind of tell you what he sees on a daily basis. He talks to a lot of loan officers, brokers, AEs on a daily basis, and I figured it'd be great to show him an example and him talk about the market, how he sees it, for some real data that really is useful for you on this call. So, Pete, I'm going to hand it over to you to talk about 3 examples here.
All righty. Well, thanks. Dave, what I'm seeing in the marketplace is a huge demand for our DSCR product, you either go in short-term rents or long-term rents. We've got experts to help you on all of our DSCR and investment scenarios. Here's one. We have an example on a long-term rent in Los Angeles, 3-unit purchase, market rents of 4,800, PITIA 3333, DSCR of 1.4, which is excellent. Investor elected for 30% down, 1-year prepay, which is available. Investors finding value. And we're looking at these, every day, and it's pretty exciting to see, it was 50% of my business last month, or our team's business in Central Northern California was DSCR. And it's just really easy qualifying. Investors it's so much different than years ago when, we bought our rentals, or Dave, you had to, when we went through this, it was more difficult. You had your Fannie Freddie, 2 years tax returns, and that's how you qualified. Right now, it's based upon the cash flow of the property, which is so nice. And you've got some savvy investors out there that really know. I like this one. It's market rents were 4,800. That's what will go off, right? They're only collecting $1,200 on each one of these units for 3750. What this tells me is this person that bought this property is probably gonna fix up these units and rent them out at market value or north of market value because they're rehab. So you're going to increase your cash flow, increase the value of the property. There's some slam dunks out there for DSCR. I prefer the South and the Southeast right now, where you see some good loan amounts and some good rents, as opposed to your California. SFR is pretty tough, but California, obviously, this is a recent funding. The units are there. So anyway, yeah, I love certain demographic areas in the country for your DSCR, but there's a lot of savvy individuals out there. It's a great source of business for us.
Yeah, thanks, Pete. We'll look at the other one. And honestly, I think, I was looking at some study today from Core Logic, and I kind of hard to believe. Again, I think it's more geographic, but home prices and home values are still going up. I do think it's more geographic, but these small to medium investors understand that the housing supply is word out and people need housing. And I think this is a good example of a savvy investor owns I know he owns or she owns other rental properties. Hey, I can get value here, get this thing up to market rents or beyond that, and then they can refinance it at that time with, maybe, and after a year, pull cash out and kind of do it again. And that's how I see some of these going in this direction, trying to acquire assets, other than, hey, you're going to put it stuff in stocks today. That I don't know. Who knows what unemployment is going to be in the stock, but we kind of see where there's asset in some of the real property out there. So let's look at the next example, Pete.
Oh yeah, this was a short-term rent. This was a good one. This was in Key West. So to back what you were saying, Dave, the short-term rentals, our team does a lot of them. We're pretty darn experienced with them. We based this one off the Air DNA, but the key to it, like you said, Dave, is just heavily trafficked vacation areas. This one this was one of my favorite ones because it was so easy to do. We just went off the Air DNA. It was Key West. The appraisal pictures do a little bit more justice than the picture there with the Scooby-Doo mystery van there behind the mossy oak. But it was literally, it was the other side of this property was on the beach, beautiful pool, infinity pool with the ocean in the back. But AE was a real pro on this, and he's like, yeah, look at these. Let's get an Air DNA. We'll just go straight off of this, and purchase. The loan amount was 615, purchase price, million something, PITIA, low millions, 5432 was the principal, interest, tax, insurance, and association. We went off the annual revenue, you divide by 12, hit it with the expense factor, the booking fee or the cleaning fee, what have you, came out to 6353. You divide that into the PITIA and DSCR of 1.1. This was one of the easiest, quickest slam dunk loans I'd seen in last couple months. And I based that upon, an area that is like Key West is going to have so much good data off of their nightly rate.
Yeah,
so it just makes it sure makes it a lot easier than
it does. It's the resort areas. Key West is one. You'll get ample data in those resort areas. Absolutely. Let's look at another example here, Albert, and then we'll take some questions.
This was another real quick purchase, pretty darn easy. High-rise condotel. Okay, this was a second home, so we did go all doc business statements, but it clearly penciled out short-term rents due to the upscale, the Park City, beautiful property, great amenities, huge nightly rent. So it was just like, well, what's going to be the use of the property was going to be second home, but they can also rent it out. But it penciled out short-term rent. It was super quick, easy close. Key to these condotels, and I'm excited to have this product because I used to get asked for the product years ago when they started, really coming out about, at least for me, coming on the scene about 15, 20 years ago. But the key in my mind is, once again, your vacation areas, Lake Tahoe, they're slam dunks. This is Park City. But, if you get the newer properties, which most of them are, you're not going to have the issue with your studio, making sure it's a 1 bedroom, your minimum square footage, the kitchenette. So the last few that I've seen um, have been pretty darn easy, but they're also newer construction with some high rent, kind of 5-star hotel type of properties. But it's great to be able to have this product. I've been asked for it for probably 20 years, but now we have this product down, and it's a great ancillary product to have.
Yeah. It's all about helping you guys get more business, right? So I look at it, I'm going, what can we do to help you close more loans, right? And so some of it's products, some of it's, hopefully our service, which I think our service is really good, but this helps out a lot of having condotels, ITINs, so you don't have to say no, right? And so there's options for these borrowers and because every application gets valuable today, and we understand that. All right, so let's go. I think the next slide, we're going to talk a little bit about some red flags. And I thought it was important because I see all these webinars, we talk about how great it is and programs are, but some things to look out. And I've seen some articles, about, and it may have maybe to do with agency, but is it owner occupied? Is it non-owner occupied? So I'm just going to talk to you what it is. So we take every loan on its own merits. We're a true lender. We underwrite our own guidelines, fund with our own money. But what we got to do, don't use the business purpose to circumvent TRID loans, right? Just don't do that, right? It's non-owner occupied only, and if there's cash out, 51% of the funds need to be used for business purpose, and kind of just follow that. Call it what it is, and let's deal with it. If you do that, you're really setting yourself long-term success, right? I've been doing this in this mortgage business for 30 years, maybe even longer than that, and I'm going to do it again. Hopefully, I can keep going for another 30. I don't know. Maybe my wife will make me retire, but okay. The other thing too is I've seen a lot of is, and I call it like the builders, maybe the smaller builders that build a home, right? Or did this huge rehab that took a while to do, and they list it for sale, and it's not getting the price they want. And they come back to you and they say, hey, maybe I should just do cash out, or I need to refinance my construction loan. Those are difficult. I'm not going to say no to it, so we can take a look at it and give us a call. But typically the lendable value is not going to be what the list price is that didn't sell, right? So this is common sense approach, right? And if it's a builder loan, now builders, they make their money by building homes or doing some type of major rehab and then selling the property for profit. And if they're not making money, how is that going to work for you? I'm not going to say no to it. I'm just saying just some red flags to look at. Other thing too is rapid value increases in the last 12 months without substantiated improvements. Now, I look at home values and how do home values increase, right? There's really two things that matter in it, right? One is time, and the other one is improvement. So if you bought a property last month and didn't do anything to it, and now you're saying, well, I bought it for 200, now it's worth 400. Those are hard to do, right? And you got some seasoning requirements and all that. I get all that. But even if you haven't, if it's substantiated, we can take a look at those, right? That's where they did a whole rehab, that even though they bought it, and you can substantiate, we'll take a look at those, right? But be careful of those, right? Just say they got a good deal. Well, if they got a good deal, someone didn't. And if they didn't do anything to the property, if I'm an appraiser, and how valuations look is I look for the most comparable comp to the subject property that's sold in that direct neighborhood in the last 6 months. and I come back and I look at it's the subject property itself, right? So those are some difficulties on valuations, especially lendable valuations. Some items to look at is unpermitted additions. I'm talking like ADUs, people doing that. Now I have seen in like especially California, some of the regulations have opened up on ADUs, but it needs to be permitted to be able to use that. So always ask the question, make sure it's legal to have an ADU and rent it out there. So, if I look at properties, it's marketability and is it legal, right? So those are two things to look at on it. The next thing, and I saw some news, got some video podcasts of somebody, I don't know, I went around viral of somebody saying he's got a new business venture and it's called, squatting in homes and how to get that. So I put on that vacant properties, right? Especially, I mean, we're really talking about refinance. Refinance of a vacant property is difficult, right? Because no one's really taking care of the property, right? So of course, on a purchase, it could be vacant. We get that, or major rehabs and renovations, and they put it on the market. We got that, as long as we document that appropriately. But just doing a cash out on a vacant property are difficult for us to do. Okay. So the next slide, we're going to go just really is for your things on the deck is kind of a matrix for you on our business purpose loans, right? To kind of go this. Right now we go up to 80% on full deck is kind of a matrix for you on our business purpose loans, right? To kind of go this. Right now we go up to 80% on full doc, alt doc, and DSCR. That's purchase and cash out. Again, the LTV needs to be there on that. No DSCR, what we mean by no DSCR, that is a no ratio. It means it's under 0.75. The max LTV on that is 70. So with that, I know we got some questions coming up and would love to take that. I see a couple in here already, so we'll take some questions now.
Yes. So the very first question, we have a question from Carrie. She wanted to know, where do we find the rent comparables in the site?
Great. So there's a retometer on our site. So I'm assuming you're looking for the comparable that you can get free from us through the portal, right? Or you're talking about on the appraisal, right? So I'm going to assume it's on our portal. It has a little click on it. I think it's on the left-hand side is retometer, and you click on it and it'll kind of pull up and you just put in your email address and the address and bed bath count, and that'll be emailed to you within a couple minutes, a comparable PDF. And if you don't, let me know. You're going to have my contact information after this, so you can email me direct, and I can hook you up on that. Oh, great tool.
This question is from
Carrie.
Ed, and it says, for condos, do you require same insurance deductibles and coverages as Fannie Mae?
Wow, that's a great question. And I'd say right now, yes. Can we look at some things on exceptions? Right now, it's like 5% deductible right now, right? So I think this is going to be a major discussion with agencies and in the non-QM world. How do we deal with the HOA fees and the cost of maintenance and insurance, specifically in Florida, California, Texas? And, because if their HOA fees go way high, that affects marketability. So as the HOA community in those condos in those areas looking around, how can I keep my HOA fees reasonable for everybody, right? And so I've seen some where they say, hey, maybe the roof's 7%, 10%. I think we'd take a look at it on a case-by-case basis and look at what it is. We'd like to know what kind of reserves they have, right? That type of thing. Any delinquency on the HOAs, what does that entail, right? So since we're a true lender, we can look at things and make exceptions on it. But typically, we've done a few of them, but we'll take a look. So the answer to that far is no, but we can do it. We can look at them on a exception basis. All right.
Another question from Ed says, do you do investor rehab loans on DSCR?
Okay, so we lend as is, and so we'd be the takeout instead of doing the rehab loan itself, right? So we do a lot of that. Let's say they bought it 4 months ago, completely rehabbed it. Typically, they get the loan from private money or some source like that. Then we at the end take it out And as long as it's substantiated, they did the improvement and the valuations there, we go ahead and use the new appraised value. But we'll need to document the improvements. And I'm glad this is a good question. So I see a lot of these loans come in because these are savvy investors, have capital. They're looking for deals, right? And it might not be the best shape house that they're buying. They either buy cash or private money because they need rehab. And it's a quick way to get in there by buying a cash. And then they'll document, did a new roof, I put a new kitchen in it, new flooring, all these different things. Please, before you order an appraisal on that one, get the list documented and send it to the appraiser when you do the order to address all their stuff that they did to all the rehab they did to the property so they can document on that. That'll help us a lot on closing your deal and then ask the question, can I get a receipt for that? Did they really do that? It's already documented by a third party, by the appraiser going out there and investigating the property. Before and after pictures are great too if they have those, right, to document the improvements.
Thank you for that. The next question that we have, and I'm just so you know, I'm just going over the questions in the order that they came in.
Okay.
Carrie, the next question is from Carrie, and it says, "Is there a limit on the condo hotels you can purchase?"
Well, there can be, right? So because most condo hotels are deemed unwarrantable or non-warrantable, and so we can, since we're a true lender, we can look at them. So if you see a condo hotel and there's a 50 unit and you have somebody who wants to buy 10 of them, that's probably difficult for us to do. They're going to buy 2 of them, okay? Because of that fact, we can't as a lender take the risk of having a high percentage of loans in a complex that's non-warrantable. And so we need to look at those case by case, right? So because those are already deemed pretty much non-warrantable. But we can get to that and look at it. Those where I need to look at the HOA cert, how many units are available, and look at the health of the HOA. If we can look at the HOA is healthy, maybe we can do a few more for you in that complex.
The next question is from John. And says, "Not sure if you covered this. If multiple borrowers are applying for a DSCR loan, what credit score do we use to qualify?"
Well, that's a real challenging one because it's going to go by that scenario. I got 10 people going into it. Please put it in the LLC, and we try to use the ones that have the most ownership in the LLC, right? So you can use we try to use the highest of the ones that are coming on there, which is fine on their score, but make sure they got the vested interest right on that. We're not going to use the one that's added on at 1% ownership in LLC because they have the 800 FICO, right? That doesn't make sense, right? So it's just a common sense approach of who's going to be on there for credit qualifying. So it should have like a 25% ownership.
Thank you for that, David. The next question comes from Janelle, and it says, if a client is buying a property that was a long-term rental, goal is short-term rental, DSCR, can I still use the short-term rental comps?
That's an interesting question. So I'm just going to rephrase it here a little bit so I can address it. So I have a borrower that is existing on long-term rents, have a rental in there, right? And now, as is, you got a long-term renter in there, and now you do want to use short-term rents to qualify it, even though it's being used for long-term rents. I would say that's not good practice, right? You call it what it is and deal with it. And now, if they're saying, hey, they're on month to month, they're going to move out, I'm going to switch this over to short-term rents, there could be a case for that. But I'm going to say in that case, you'll probably end up with the same loan, right? Because short-term rentals have a little bit lower LTV and has an add to it. So when you're looking at it, I think you get to the same spot. And I believe in calling it what it is and dealing with it at this time. That's your best path to get the loan closed. Is, hey, what do you have? Let's just deal with what it is. And if you go straight up to them without trying to say, what about this? What about that? Call it what it is, and we'll go the extra mile to try to get that loan funded for you, what that borrower and you need to get done.
you for that, David. The next question, Mark, and it says, is there a product for a mixed use property?
Well, yeah, that's another interesting, because it really goes into what do you mean by mixed use, right? So, and again, in our guidelines and in how we kind of interpret mixed use in the residential sector is it could have some light commercial aspects to it. I don't know if it's units, maybe it's a 4 unit and one of the units got a little bit of light commercial and it's in an area that is common, probably be okay, right? What we don't want is that garage, mechanic shop out front and the home out back. That's probably not feasible. So it's look at the utility of the property, and that's kind of how we do it. So, again, mixed use for us is probably okay. It's probably residential most. That's how we're looking at it. But it could be used a little bit of commercial. It could have insurance agency of it, but they didn't do any structural things to it, that kind of stuff. So on the mixed use, that's more, most of the ones that come over, hey, they'd probably be more on the commercial aspect utility than the residential.
The next question comes from Joe, and it says, the customer has her lease agreement and has been a landlord for several years, but she collects her rents in cash and she does not deposit it. Do we
So if I hear
off the
right,
rent
so
schedule and lease agreement for DCR, or
so
we have
so that's a perfect case of why we have DSCR, right? So and I get it, right? So I actually think there's a lot of landlords out there that don't want them to pay by check, right? Oh, what was that like? There was a comedian that did that. It's like, hey, you're knocks on the door, you're late in your payment, I need the payment. I don't have any money. Well, do you have a check? Oh, you want a check? So they give them a check, and the check's no good, right? So there's a lot of landlords, hey, pay me cash, and they don't actually deposit into the bank. So in that case, on that refinance, right, because they're saying it's in there, we're going to go by the 1007, or that's a SFR condo, or the 1025 that's units. No, they won't even need that. So the appraisal will just have that on there and add that in. So we're going to use the 1007 or 1025 if it's units. That's a good one for us, and I think that's a deal we can help you out with. All right, Albert.
Thank you for that. Awesome, thank you. As far as some of the other questions that we had scheduled, or that we had already asked, that had been brought up before. So one of them I think it's a great question, and is, can the broker order an appraisal before the borrower signs intent to proceed?
On a business purpose, yes, they can order the appraisal anytime. And I was, because really, I have a lot of AEs that have good relationships with their loan officers that they do business with. They say, I'm doing a DSCR. I go, what's the price, right? I need to go rate. Well, what's the DSCR? So they kind of figured out it's at 75 or 80. Here's your ads. But they order the appraisal. Sometimes they come in with the appraisal, because that's really the underwriting factor of it. Isn't because the credit's good. It's clearly a non-owner occupied. It's going to be a purchase, and just order the appraisal right away, right? So you don't have to worry about the disclosures, the notice of intent to proceed, and all that on business purpose. So please order that right away. Take it off the market. Kind of figure out what the max LTV, either way, a kind of payment structure, so you kind of be upfront and you're upfront with them what it could be, but then you can get that 1007 out of the way, because honestly, that's really the underwriting that comes into it, is that property, is the property conditions, like you see some of that, because these are savvy investors. They kind of know that some things might need to be done, so we can address those. Or the 1007, what's going to come in. Again, these are appraisers, and try to give them as much data as you can when you order the 1007, right? Because they have limited access to what rents are in certain areas, right? If you go to MLS, they're going to try to find out. A lot of people don't, a lot of these investors don't advertise on MLS. They use different sources to get to that rental. So if it comes in low, you're going, wait, no, this doesn't make any sense. And I've actually seen that. Then you're battling the 1007, right, with the AMC, and that's no fun, right? But if you can be proactive and say, hey, here's 3 or 4 comps, you use a retometer, say, hey, here's where they're at, this is what we're ballparking at. They might use those comps to help you out on that 1007 or 1025 as you go down the road. So that's a good practice to get in. Be proactive on that 1007, that schedule of rents that you get out.
The next question we have is from Carrie, and it says, if buying DSCR, do you have to own a primary residence?
Great question, right? So on our guidelines, you don't have to own a primary, but here's where I caution you, right? It's going to have to be clearly an investment, non-owner occupied purchase, right? So how do you distinguish that? And I live and work in Orange County, California, right? And I rent a nice place out. Man, it's too expensive here, but I want to diversify my portfolio and buy a 3-bedroom, 2-bath property in Las Vegas to rent out. I looked at it, the DSCRs there. Does that make sense? Probably, absolutely, right? And the DSCR is going to be over 1, right? So we put some caveats on it if you don't own a primary. DSCR needs to be over 1, and it's got to make sense. I'm not going to buy a rental property, 5 miles away from where I currently live and work. Then you got into, maybe it looks like it might be occupancy fraud, where, hey, you're circumventing the rules of trying to get a purchase versus a TRID loan versus a business purpose loan. And that's what I'm trying to avoid. But we're not saying no to that, because I think there's a lot of individuals out there that say, hey, I want to rent. It's better that way for me. And I'm buying rentals out there. And so if they own another property and they're historically have done that, it kind of puts in favor, hey, they're renting, but they own a couple other rentals. Okay, yeah, that probably makes sense, right? So it's really a common sense approach to it. On someone that doesn't own a primary right now.
Thank you for that, David. The next question comes, it's from an attendee, and it says, what is a 1007 and a 1025?
What is it? It's just a rent survey from the AMC. The appraiser goes out. 1007 is done for single family residence and condos type, right? 1025 is a small residential appraisal report. That's just a Fannie Mae rule things for us. 1025 on what you order. There's a Freddie Mac one too, but I usually just call it 1007, 1025, and that's used for 2 to 4 units, right? So it's just the name of the appraisal category that I'm using. All right, so here's our next webinar, right, Albert? And I'm going to take over on this because I think you're having some internet, some glitches there. I think you're at our corporate office too, which I'm kind of like, maybe it's the location you're at. So it's not on you, not on you, Albert. How to close more owner-occupied second homes and non-QM programs. What I'm looking at, if I see the increase of consumer purpose non-QM, right? And probably the larger loans, because if you look at jumbo prime or prime jumbo pricing versus non-QM, a lot of cases, we're pretty comparable on those, right? And so let's look at those self-employed borrowers, and we even get some jumbo prime in of how we can close more of these owner-occupied wide while it's still purchase season here and that, and go through how easy it is to look at the alt doc, how to use our portal and upload the bank statements you're in, kind of see where it's at, and get those loans closed for you, and hopefully further your relationship with real estate agents. So that'll be next month, June 6th. Right? At least it doesn't have another 6 after that. It's June 6, 2024, right? And then the next slide is going to have my contact information. And please give me, you can call me, you can email me. I'd love to, dialogue with you and answer any questions that we didn't cover here today. So I pull that up. And again, everybody gets a copy of this deck and this recording. Hopefully it'll be sent out, 2-3 hours after we finish up, right? Don't even see my contact information here. Well, There it is. Let's go scroll down a little bit. There we go. There's my contact information. Please visit our website if you got any questions. We are forward facing. You can, do a chat on there. We got some rate sheets on there. And then if you want access to the portal, please send me an email if you're not approved with us, and I'll get you to the right person so we can email you out your credentials to log on in and close more loans. So thank you for attending, and I look forward to seeing you in June, and let's close some more loans this year, right? Looking forward to it. Thank you.